Live from Western Massachusetts and Northern Westchester County, it's David Balin here with Stephen Whiting on The Point. Today's subject is redefining the Middle East. The actions that have just been taken by Israel and the United States in the attacks on Iran are reshaping the entire contours of the Middle East at this time. And the title of our presentation is All That Glitters Is Not Oil. And the reason that we're talking about this today is that there's a lot of false assumptions about the length of time that oil spikes and shortages can actually affect the economy. Stephen is an expert in this. But first, let's sort of start with the fact that this is a different circumstance than we faced before. It's a real war, not a proxy war. And this was a war with the intent of actually overthrowing Ayatollah Khomeini. And in the first hours of strikes that actually took place, the idea of regime change was, in the actual stated purpose for it. And what Stephen's going to talk about is what actually happened in the preceding 6 weeks leading up to the war in terms of energy and energy prices, which I will not talk about here. But unlike previous wars in the Middle East, in some ways we saw the reaction of Iran basically attacking both military and private and residential properties in the Middle East was a completely different action, indicating, I think, the isolation that they felt and the need to strike against all of the different countries that were supposedly aligned with the United States. So what we're going to look at today is what the impact of this war is having on markets, looking at all of the predecessor events that have taken place in the Middle East, specifically related to oil and politics. And what we'll walk away with, I think, is a sense of what to do, which is in a sense, not much, in the sense that we think that portfolios need to be left largely intact with the few changes that Stephen is going to talk about. So with that said, let's move to the next slide. There are 4 questions. Why did Iran get struck? What was different about this strike? Do we have enough oil? And how long will this take place? So first of all, the United States had designated Iran as the single largest state sponsor of terrorism. That had been on file for probably 2 decades. The U.S. decided to take military action with Israel. But what happened was the attack on the UAE, Qatar, Saudi Arabia, Bahrain, and others by the decision by the Iranian military to basically strike out at all of its neighboring states. For the moment, the Straits of Hormuz are largely shut for trade. And as a result of that, Qatar has actually had to shut in their gas production, and the Saudis have actually had to change their refining schedule. My understanding, Stephen, you'll update me on this. And beyond the disruption now, looking at the macro circumstances, global oil markets were already oversupplied. And that has a huge implication for what ultimately happens here. So what we're going to talk about today, and Stephen's about to talk about this, is what is the history, right, that goes beyond this? And what is the actual impact that it will have on markets in the near term and over the medium term? So Stephen, I'll turn it over to you for the analysis that you've got in the next several pages.
Thank you, David. And so first off, we're not talking about the politics of this, what, why, all of these sorts of things. What we really want to emphasize is the scope of the shock. The Straits of Hormuz, this small space between Iran and its neighbors in the Persian Gulf, is a vital artery for about 20% of global crude oil exports around the world. So it's a massive, massive area or supply choke point. It is closed now as we're facing a hot war. There were lots of predictions of incredibly large price spikes. And we've emphasized that the price of oil is incredibly volatile. It's consumed very fast. When you see these shut-ins in places like Iraq, the whole point is that they don't have enough storage for the oil coming out of the ground if they can't ship it away. So there can be very large price distortions here. But we want to go to the next page and talk a little bit about the history here and the circumstances and how different this is from, for example, from the conflict in 1974, when OPEC countries deliberately restrained oil exports to the rest of the world. That was a time in which American oil output was down 20% from the year earlier, when it was incredibly vulnerable to an oil embargo. And this is not happening at all. I think the points that David made earlier about Iran striking out at virtually every country to its west and south to pressure an end to this conflict, that really is quite telling. And I think it's creating a very clear reaction that this is going to actually have to find an end. But let's go through a little bit of history here. Now, let me say first, the oil price this year rose 15% ahead of the conflict. We'll talk about it a little bit later. There were probabilities priced into markets like Polymarket that there would be a 70% chance of a strike. And so there was a good deal of anticipation that this event would occur. Now, I want to go back to a little number one there, around 1990. That's the first Persian Gulf War. That was a time in which the first President Bush went to Congress. There was the Iraqi invasion of Kuwait. There was a big, slow military hardware buildup, not just air power. And there was a great anticipation of an oil shock. During that time, the oil price was rising very rapidly. Well, the actual oil shock was delivered 4 or 5 months later as Iraq retreated from Kuwait and set all of their fields on fire. The price of oil, you can see, had a very brief spike. It was severe at the time, but it rose so much in anticipation, it fell afterwards. The basic point here is that during oil shocks, commodity price supply shocks, traders, even back in the early 90s, they want to get to the worst case crisis price. And when you get to the crisis price, we tend to fall thereafter. Now, you can see another period here. I'll just go to that number 3. The one that kind of most resembles this recently is Russia's full-scale invasion of all of Ukraine. Extremely important. At the time, Russia was a massive oil exporter to the rest of the world. Now it has more limited customers. We ended up having to redirect oil trade around the world over that balkanizing conflict. For a brief period of time, oil reached $125 a barrel. But the point was that it actually peaked just 2 weeks after Russia's invasion of Ukraine, which had a lot less predestined sort of understanding about what was going on compared to the Persian Gulf War. Now, if you want to see a really high oil spike, this is very different circumstances, completely different circumstances from a conflict. It's 2008. The crude oil price reached $145, but look at the blue line. That's American oil output. Completely at the lowest level in decades. There was this shortage of oil, extreme dependence around the world on imports at the time. This is before the shale revolution. And again, old technology applied to massively increase that blue line, which you can see now American oil output at an all-time high. And this is the thing. If we go to the next page, and you take a look at the situation of supply and demand on oil, we had OPEC reverse production cuts of the last couple of years. We have some drops in oil output from Russia, but we have American oil output at an all-time high. By our estimates, you can see that left picture, global crude oil supplies have risen 5% over the last year. Energy demand and intensity is going down over time. Just take a look at China on that right picture. Now, there's some effects of the Chinese New Year. There's some brief volatility here in that latest drop. But what that shows, that big uplift, is the dramatic increase in electric vehicles and hybrid vehicles sales in China, despite a low oil price. So again, one of the major sources of the world that people were thinking back in 2008 that we were going to run out of oil is that China would be absorbing all the world's crude oil, that we would use it inefficiently. We have massive increases in energy efficiency and a trend in the economy. So all-time highs in the crude oil production gave us a $60 crude oil price before there was any concern about this rise in geopolitical risk, the invasion of Iran. So what we're telling you is that when the Straits of Hormuz are open, when there's another month or so, again, for the whole region to get its production back online, we can't tell you when that'll happen, but when it does, there's very likely to be a large drop in the crude oil price. And the major issue here for investors is not to align your long-term portfolio with a spike in the crude oil price that isn't going to last. David?
Great. Thanks very much, Stephen. So with all of that, you have some good background and to understand the nature of the elasticity of the price of oil, which I think is extremely relevant to this conversation. But ultimately, you can see that the long-term impact, right, is actually not that significant. So we begin this year with very high oil production, and we can also see, of course, the slide on the right, which I really love, which has to do with the electric and hybrid vehicles as a percent of sales, which has fallen temporarily right now. But the fact is that is going to have a larger and larger impact on the demand for oil over time. Next slide. So since Stephen mentioned that a lot of this was anticipated, right? Which is that we saw an enormous amount of activity where prices had moved up, right? We've also seen a large increase in energy shares since the beginning of the year. And we've been asked by many of our clients and prospects whether or not energy shares are a good purchase right now. And our answer actually is that they're not. They've been deeply impacted by increased profits that have been anticipated. They're going to make more profits as a result of the shortages that are going to take place. But the structural nature of the investing in that area is not something that we like on a direct basis. However, it does underscore a trade that Stephen and I put on about 3 weeks ago, which is an actual addition to MLPs, Master Limited Partnerships, that have to do with energy infrastructure. And these have two interesting characteristics. One is that they're income oriented. Two is that they're infrastructure, so they have an inherent inflation hedge. And three, they actually have the possibility of volume increases, which will drive the value of them up. But Stephen, you were telling me that there's a fourth benefit, which has to do with taxes and how they're actually taxed for U.S. taxpayers.
Well, yes. So if you were to own the individual MLPs, we're just thinking about like Western Midstream Partners, or again, as an example, as the dividends are paid out, it reduces the cost base for the underlying investor. Now, the tax accounting may be a little bit complicated, but this may be a more efficient way for an investor to take a position and in a less diversified way in this income flow. So we'll talk a little bit more about that later in the presentation. I'll just take you to the next page real quick. We already mentioned, you can see that map, that choke point, the Straits of Hormuz. You can see some of the things that have happened in terms of production on the right, the dramatic number of countries impacted. This is going to have an incredible impact on the region. David and I have both traveled heavily throughout the region and seen these countries firsthand. You know, the fact that almost all of them are being attacked by Iran, again, whether they're being effective or not and what Iran's ultimate aims are. Even Oman, which was serving as an intermediary to try to broker a peace deal, was sent some attacks. I think that just really clarifies, you know, how isolated Iran is in this particular situation. Well,
that's right.
Why don't you just take it to the next page? Right.
That's right. There have been attacks, Stephen, even today. You know, the sixth day of the war. You know, on Doha, and you know those have been extensive because a lot of these countries do not have the aerial defense systems, right? Which protect other countries. But go ahead. I'm sorry. Keep going.
So let's just stay on this big subject, though. And, you know, again, there's so many nuances, how monetary policy can be subtly influenced, the difference between countries, etc. But I want to just, again, go back to a big picture here. And for those of you who want to contact us, we can send you this data table and more. What we did is we took 21 geopolitical events beginning with World War II and take a look at when these shocks occur, what the initial impact is. The initial impact is a drop in risk assets. In some cases, it's been a rise in oil prices. But it's very rare for a regional geopolitical shock or a conflict zone to change the direction of the whole world economy. World War II obviously changed the whole world. Nothing comes close to it. OPEC embargo of 1974 was one rare case, so less than 10% of all cases, where the world is extremely vulnerable to an oil shock. And we ended up with, again, a concerted effort to push up and reduce energy supplies, and that catalyzed an inflationary recession. These are not those circumstances. And so if you take a look on an average, usually it's 30 days after one of these shocks occurs, we have equity prices have fully recovered and more. So it's very likely, you want to be very careful not to align yourself with temporary distortions.
And that included even 9/11, Stephen, to the point was, so it is truly rare for the distortion to be sustained. Next slide, please. So with all of that, um, you know, and obviously, this has been completely blotted out from all of the news, is that in February, we saw a continuation of the increase in manufacturing, health, and data in the United States, with an increase again in the ISM, the manufacturing index, the composite index. This underscores the broadening economic expansion that Steve and I wrote about starting really last October, when we anticipated that the supply-demand relationships in the economy would actually equilibrate, allowing the manufacturing economy to actually expand. What's interesting, Stephen, and I'd love to get your comments on this, is that we're seeing that expansion in spite of the fact that labor demand in the United States continues to be unusually weak. So the question that I am sure people are thinking about is, how can manufacturing be doing materially better when labor demand is actually still extremely sluggish?
Well, I'd start with saying that these signs that continued in February were quite skeptical of January. They're merely incipient, right? There are preconditions for a broader recovery. The oil price, we're in well-worn ranges. We've been here many times before at $80 oil. Again, it'll matter again, a little bit of a sap in income. But what you saw on the right there, for example, that mortgage spreads are coming down. So even as the Treasury yield has drifted a bit higher, we're seeing mortgage rates more affordable. That was a precondition for a recovery in the construction sector, which slumped last year. Now, the story on employment on the next page is that we had these trade shocks. Just last week, we talked about all this trade policy uncertainty, and, it's still there. But if you take a look at that breadth of employment in the United States, last year, we had 54% of private sector industries reduce employment, but it wasn't because of AI. If you just take a look at that right picture, the software industry, employment in various really labor-intensive technology areas. You remember the stories about hoarding labor for tech companies? Because the tech boom was so fantastic, we just better hire everybody we can and sit them in a cube until we're ready. Well, there you can see it in that chart. So when you see stories about Square, for example, and Jack Dorsey reducing all of this headcount, you got to remember where we're coming from. This narrow area, again, is subject to employment declines. But so many other broader cyclical areas, marketing, sales, finance, all of this related to trade cycles and manufacturing, again, not really directly measured in manufacturing, but we have room for improving the labor market. And we're saying that even as we're absorbing a shock that's hurting confidence now.
That's exactly right. So let's go to the next slide. So one of the things that we wanted to point out, and this is a very subtle but very important point, is that you have to take a look at not just the performance of technology, but rather take a look at the performance of both software and IT services, right? And hardware, right? And semiconductors. And you just think about it, hard versus soft. And what we like to do is to go back in time and look back all the way right into the 1990s to take a look at the relative performance of the two. At times when you see software grossly underperforming hardware, those are times that indicate, right, that it's likely to see a snapback, because the relationship between the two of them usually is not entirely in equilibrium, but it's indicative of what's taking place in the market. When you see hardware being built out, that's the infrastructure part. When you see software, right, doing better, that's the actual economics of building the services, if you will, that people buy. Well, right now, if you take a look at the left-hand chart, you'll see that we're at one of those times when software is well underperforming hardware. And as we talked about in several of our written pieces, we don't think that all software should be treated equally. In fact, we think there's going to be an enormous discernment between essential software that has a moat around it, like cyber security and cyber defense, and other areas that are more generic, right, which could have to do with, for example, art-based software like Adobe, where there's much more a risk of an AI impact on both labor and the ability to replicate some existing software packages. So that's why one of the things that we expect over the next several months is a general recovery in software, but a definitive recovery in those software companies that have moats. On the right-hand side, you can see even more dramatically some of what we're talking about. So The black line is human resources and employment services. The brown line is IT and consulting services. And on the right, you can see electronic components. This is an exact replica of the big chart on the left, which shows you how disparate the two are. So, Stephen, there's this more subtle point here too, which is that we've been saying for a while that the growth rate in hardware itself is unsustainable. And that, in addition to the ratio of the two, could be a reason why we could see a relative recovery in software.
So we got to talk about this because software and hardware are bundled together to work in the economy. So it's unusual for them to go in completely different directions. Why bring this up at all when we've got a war in the Middle East? It's exactly because we're finding market dislocations that have nothing to do with the price of oil. Now, you can take a look at the next page, and this is going to be really important for portfolios in the coming couple of years. You see the left picture and see that build out in data center computing power. NVIDIA chips, servers, these are growing at an unprecedented rate. The data suggests it's going to continue to boom in 2026. Public company spending plans show a 54% growth rate in their capital investment. So even more going in directly into the build out of AI infrastructure. This is why memory chips, this laggard, is suddenly up over 100% over the past year. We don't think 2026 is the period where fundamentals are going to weaken. In fact, we've seen some projections that project this out to 2028 and beyond. I think our base case view is going to be it's going to be very difficult to sustain beyond 2027. So hardware investments, which are just far outperforming software investments right now, this dislocation, again, is going to, at some point, it's going to matter. And the software has been treated as if it doesn't exist anymore, while the hardware is treated as if it's going to go on forever. Now, I want to give you a final example of this that's really important on the next page. Right when
Stephen,
we're in the heart of the conflict.
Before we leave that page, I just wanted to say one thing. Thanks. One of the reasons why the market's going to go up, and one of the reasons why the market is strong, and one of the reasons why the market has resilience, right, in a circumstance when you have all of these different things, AI and the war going on, is because of the right-hand chart, which is that you're seeing increased earnings as the number one power driver for the S&P 500. And don't forget that, because that's when people say, well, why should one not market time? If we thought there was going to be an earnings recession, we'd be telling you there isn't one. Stephen, go right ahead. I'm sorry about that.
No, absolutely. Let me just say this about the semiconductors first again. The piece of EPS that has the strongest expectations for this year, semiconductors. About a 65% EPS growth rate with probable upward revisions. And what you've seen has been this terrible underperformance of software. Not 66% EPS expectations, but 15% or so, and not getting cut. Now, I just wanted to focus on something that I think is very tangible at a moment like this, and that's the left picture. Now, if you can take a look at that light blue line, it shows defense contractors, the Lockheed Martins, for example, and cybersecurity firms like Palo Alto. You know, for the last dozen years or so, cybersecurity and physical defense spending have gone hand in hand together. And it will be an issue going forward with this conflict in the Middle East and other conflicts that still rage, including Russia and Ukraine. So you think about this massive dislocation. We have been overweight both defense contractors and cybersecurity for this past year. But when you think about one suddenly leaping 80% more over 12 months than the other, one down 4% over 12 months, the other up 76% over 12 months, you've got to think about what is embedded in expectations and why would we suddenly believe that Claude is going to suddenly create some kind of software, some cybersecurity protection for you. So we really think that this dislocation in software right now is an opportunity that investors are not going to focus on where they're sending all of their money into energy shares. Now, David, there's the other one that you mentioned earlier about.
Yeah, this is probably, you always get to talk about your favorite charts, right? So this is my favorite chart. This is my favorite chart because if you had done like a predictions market about what I'm about to ask you, let's see if you would have gotten it right, right? So which right, of these two indices, right, since January 1 of 2025, sorry, has performed better? The total return on master limited partnerships or the total return on the NASDAQ composite? And you would have said, for sure, it's got to be the NASDAQ, right? You would have been wrong. Because if you take the dividend income and price appreciation in MLP land, you would have seen that that total return actually exceeded the NASDAQ since the 1st of January of 25. What does this speak to? This speaks to this idea of why you would actually diversify your portfolio and include MLPs, because they have a high total return, as you could see, but most importantly, a return profile completely different, right? And completely diversified from technology. And our job, as Stephen's been hinting at pretty directly, is that as we begin to get to 2027, as we become more concerned about the ability for hardware to sustain these outrageous growth rates and profits, we want to build things in that can perform with a more steady process. And that one of these right now is MLPs. So good. Yeah, so next slide. So you can contact us because this is the last slide. But what we want to conclude with is that it has been a pretty extraordinary 3 weeks. We've had an AI scare that has had a deep impact on parts of the market. We're going to be publishing on that subject over the course of the next couple of days. We've had a war which was somewhat anticipated, but the degree of conflict and the breadth of that conflict has been far in excess of what anyone had anticipated. And ironically, even though markets have taken some hits, we saw in the last couple of days a fair amount of resilience, even in the software sector. So one of the reasons we wanted to talk about this today is that it's important as we go through these crisis periods and difficult periods that we provide you with our best advice, which is, has to do with staying the course or changing portfolio construction. And we are staying the course, and we have changed portfolio construction. But this is not a time when one should actually think about, right, taking money off the table or making knee-jerk reactions and buying energy shares. It's a time when we have to take advantage of the opportunities in front of us, and at the end of the day, pray for peace. So we leave you with those thoughts. Stephen and I will be back next week. We will be publishing this weekend, a regular point as well as a special bulletin on AI. And we very much appreciate your attending the call today.
Thank you.